30 days ago. Although anything with a court system tends to drag out. But I do expect three things. I expect the city of Flint to have to accept what the tenant says, I do not want an inspection. I expect them to have to take that because that comes from the U.S. Constitution. I also think that they're going to have to put the water in the tenant's name and not your name and not for $75. In other words, I think they're going to throw that out. And I do hope that we win it overall, but it may be too much to ask for that they throw out the inspection completely this time. So, but that's an update of what's happening. Any questions?
No, but thanks.
Frank calls me. I thought we had more questions. Thank you, man.
The Godfather.
All right. Next thing is Mr. Bernard Drew for a fantastic introduction for tonight's vendor. Please help me welcome Bernard.
Come on, just give it.
Hey, we're going to keep it simple. Good evening, everyone. We are excited today to continue to bring value as you look at your business, your houses, and your buildings. One thing's for sure, I think there's a couple things we all know. What do they say? You can't get away from death and taxes. Well, we know that we've got to deal with taxes on our properties. And a lot of that times that comes down to valuations. And so we're privileged today to have Carrie with us from CMH Appraisals, who's going to share some industry insights as well as some details about their business in terms of how their business can help your business. With that being said, I'm going to receive Ms. Carrie now. She's going to give you maybe about 2-3 minutes of power-packed action, and we'll go from there.
Good evening. My name is Carrie Lloyd, and I am a certified residential appraiser, and I've been in the business for about 30 years. Me and my husband, we've had our own company for the last 24 years. I've gotten to know a couple investors over the years by doing the appraisals for them, and Jeremy Wheeler was the one that recommended me come and speak to you about the property tax appeals. Property taxes in Michigan are based on the value of your property and the millage rate per your local municipality. Each millage rate of each local township and city is different. You can go to the state website, to the property tax estimator, and that will give you an estimation of what your property taxes will be based on a value and the millage rate of the location that you're at. Now, right now, it's showing the 2022 millage rates. The 2023 millage rates will not be available until August of 2024. Some questions regarding property taxes. Is there a cap on them? Yes, there is. It's 5%, and that's from the Heatley Amendment. Each municipality can vote higher, but the local electorates must vote on that, and that would be me and you, and I don't know of any where they have increased higher than 5%. It could be possible, but I don't know of any. Another frequent question people ask, are the property taxes based on the purchase price? The answer to this is no. The assessor can base it on the market value and not your sales price of what you bought the property for. A few things to look at when you're deciding to fight your taxes. With your property, has there been any improvements or any added structures to the home that the local municipality might not know about? If that is the case, you need to relook at it and decide if you want to follow through and fight your taxes. Once you follow through, fight your taxes, this opens up the assessor to view your property. Other things to consider when trying to decide to fight your taxes. Have you changed anything that might not be up to local building code or zoning code? Those things also, the assessor can come into the property and look at. Few things how to appeal your property. You need to make an appointment with your assessor and you discuss how the value is determined. When you get your property assessment, all the information on how to appeal that will be on that property statement. When you go and talk to the assessor, you need to write down everything that they're telling you, why they have you at a certain value, what were the reasons why they increased you, things like this. Everything that you know what they say will help you with your appeal. Once you talk to your assessor, then you can go to your local board of review, and at that point you need to come in with an appraisal. Would be good, but per state law, they only give you 10 days. The mailing goes out 10 days before the first date for the local board of review. So that does not give you enough time typically to get an appraisal. So your best bet is to get sales that are similar and go in at the local board at that level. You need to fill out the local form for 2024 and present that at the same time as going against the board. Typically at this point, I don't know many people that have one at the local board level. Usually if you do win, it's because they have said you have 2,000 square feet when in actuality you only have 1,000 square feet. You've got 2 bathrooms, you only have 1 bath. Usually things like that is just an error on the assessor's card, and that's another thing. Always look at your assessment, look at your card, see what they are taxing you on. Because as an appraiser, I have seen a lot of assessment cards that don't even match the property. In a lot of these townships, they don't reevaluate these properties. So know what you're being taxed on.
Should we go in and ask township or city to get a copy of our assessor's card?
Yes, this is all public knowledge. Right now,
That's
online,
important. I want to say to everybody, that's really important. And I'm going to mention why when she's done.
yes, also online, BS&A is the website to get all the local municipality data. You do have to pay, it's a $6 charge if the township is not free. But this will also give you all your information on the subject property.
BSA.com?
BS&A, yep,
BSNA.
yep. And they do pretty much,
The whole state.
yeah, the whole state. And they're pretty much getting each township slowly by slowly. So they're pretty much all in there. So one thing, to fight your property taxes, you must go local level first. You cannot bypass local level. They will disregard you if you just jump to state. So you have to take the necessary steps. When you go to the state level, that's the tax tribunal small claim court. At this point, you need the state form. You need a very strong appeal letter. And in this letter, you're going to be pointing out everything that the assessor is valuing you on versus what you believe you shouldn't be valued on. Everything just needs to be black and white, telling you exactly why you disagree with what the assessment is. Also at this time, you have to pay a fee. The local level is free. There is no fees with that. With the state level, the first fee is $125, and that goes up to a value of a home for $100,000. The next fee is $200, and that's from $100,000 to $500,000. And then if you're over $500,000, the fee is $300. So at the time when you send in all your information to the state, Michigan Tax Tribunal, you need the state form, you need an appraisal, you need a strong appeal letter, and you need the fee. All 4 things need to go in to the same package when you mail it out to the state. If you are missing one of these things, you don't necessarily need an appraisal. You could always submit sales. But once you're going up in an assessor, your best bet is to have the certified appraiser have an appraisal showing what the true value is. That just helps. It's a legal document, and it will fight an assessor's value. I do have sheets that he maybe has passed out to quite a few people. And all it is showing you all the guidelines of what you need to follow to appeal, state level, local level, state level, the 4 things you need at the state level, and then any of the information at state level, where you mail it, the phone numbers, emails, things like that. Also, the property tax estimator is in there. I can also email these letters to you because you can click on the links and it will pop right into the site that I'm referencing. Has anyone fought their taxes at a local level? Have you had luck?
No.
You have had luck? Okay.
There was an error, they didn't put my land exempt. They had 52 acres of agricultural land, and they didn't mark it exempt.
Okay, so it was an error on their part. Okay, anybody else? That it was not an error and you fought them and won? And you did it at local level?
Yep, they estimated it at 300, 400,000, and it was actually worth 170.
Okay. And so you didn't have to go
They
state?
reduced it. They had to.
You didn't, and so that was local level?
Yep.
When was that?
We buy that.
On Beecher?
Yeah. 5 years. 5 years. 5 years.
About 5 years ago? Okay, that's great. So has anybody went state level?
Commercial-wise, the Flint Township lady Paula, if it's way out of line, she's pretty reasonable.
Okay.
Because there's so many low sales in Flint Township that she knows it's a losing battle. But I've had to appeal Flint Township 3 times now, because she'd give me slight reductions, tried to keep me happy, but they were still like, say, they were taxing me on 4 million, I paid 650, I was trying to get it to $1 million, and she dropped it to 2.5 or 3. But it was at 4. So,
Right, so she did lower it.
yeah, a little bit.
Okay, right. Has anybody went state? You have.
Yeah.
How did that go?
It went great.
Okay.
Pissed me off, but it went great.
So you won?
Oh, yeah, I won.
Okay.
But the very package that I prepared and took in and showed the local assessors who denied me is what was sent to the state. And the state sent it back to them and they said, oh, yeah, well, we're gonna work with you. And I'm like, what? Because I hired a company back in the day to fight the taxes for me. And he went in, and he sat down and he handed them the package, my package with his label on it. And they folded like a deck of cards. I was like, but, you know, that was a good deal for me.
I've always settled. Like 1 or 2 weeks before the hearing, they always call and make me a decent offer. So I've never actually had to go to the hearing. I've kind of wanted to go, but
This year I'm gonna go. I mean, I just offered this when I was talking to Jeremy. And so I want to get more into it and understand it, because I think the Michigan Tax Tribunal is very legal. You know, you need to know the lingo, you need to know the terms, you need to know what to say, how to say it, when to say it. So from what I've heard, the tax tribunal actually comes right to Grand Blanc.
I had one in Grand Blanc Township, and I won the appeal at the state. I can't remember if I won it or we settled right before the hearing. The very next year, they just raised my value back up, and I couldn't do anything about it.
the SUV, not the taxable.
Right. So they wanted you to fight it again.
Well, it just means that they can do anything they want. If the state drops it, and they turn around and raise it the next year.
But they probably
What do you
didn't
really
raise your
want?
taxable, Henry, they probably only raised your SEV. Because they did that to me on one that I fought in Linden, and they dropped it to, they were saying it was worth 175, I paid 18,000, and I got it dropped to 40, and so they were taxable and SEV both set at 40. Next year, they jacked the SEV back up, but my taxable's still low.
Right.
Right, and that's really the key, is the taxable
Your
rate.
taxable value is automatically going to increase 5% each year. That's where you're going to see that 5%. The SEV is not going to show a 5% increase. It's going to be your taxable value. And that's what you got to pay attention to.
Well, I'm going to interject here. So, when she was, so in a different life, I actually worked for Oakland County, and I did some work with their tax people. their assessors. And just the reason for getting this property sheet, why it's important, is let's say we all lived in the same neighborhood. And Henry put in a swimming pool, redid his kitchen, his bathroom, added a second bathroom, more bedroom, and so did Terry Hansen. And the assessor goes, you know, all these houses are about the same year and age. I'll bet a lot of people have done that. And they will go into your record and put that you've done the upgrades, so they can tax you more. Because that's what they were doing in Oakland County, and that was 35 years ago. So they said, they looked at the whole neighborhood and said, well, a couple people have done this. I bet more people have done that. And we're gonna add that to their record so that we can raise their taxable value.
Fenton Township watches the MLS on Lake Fenton looking for finished basements that the tax records say are unfinished.
Yeah, she's,
I listed a house on Lake Fenton, his basement wasn't finished when he built the house, and he listed it, and it fell apart in the fall, and they raised his taxes $7 grand.
yep, she also pays quite close attention to the properties on Lake Fenton that are getting bought for the small homes, getting bulldozed, and then new homes getting put on. That makes the dollar per square foot on Lake Fenton much, much higher. I've had many, many conversations with Julie. So,
So I got a quick question.
yes,
So today the taxable's 50, SEB's 80. When we buy it, do they typically jack it to around, somewhere around that SEB?
I have no idea.
Okay.
Yeah.
Because that's what I've seen happen.
Yeah.
Maybe in a similar question that could be relevant to some of you guys. I bought a house from a lady 2 years ago. She's in her late 60s. Her grandfather built the house. It's been in their family for 80 years. And so the taxes are dirt cheap. So I've calculated my cash flow. I've looked at, oh man, these taxes are cheap. I'm charging this much for rent. My insurance is this. But what I do know is going to happen is that those taxes are going to get uncapped. And the super low taxes that I have right now that make my cash flow look really good, the day is coming where that's going to change. And I don't know to what extent you can speak on that from your lens.
I have a whole sheet calculated.
Wonderful. Wonderful. Ed's about to pass something out.
Well-
Has anybody else experienced anything like that where your taxes got uncapped and all of a sudden, whoa!
That's where you go online and use the Michigan site to
Yeah, the Michigan tax
your tax.
estimator.
Every time you buy a property, you ought to go on there, and even though it's not 100%,
It will get you
it
very,
gives
very
you really
close.
close to what you're gonna.
Because it breaks down, puts you in the township, the schools, everything.
Make sure you do that so you don't have a surprise. Particularly some of you that may use hard money, you borrow some funds, you get a partner, you think there's enough money in the split for everybody to make money, but you haven't looked at what it's going to be when it uncaps.
Yeah.
That can be a very heartbreaking conversation
That can take
when
from
that
cash flow,
happens.
positive to negative.
I just saw a property, it's a small commercial building that a nonprofit had and a for-profit business bought it, and they're trying to sell it on land contract. The taxes got uncapped, 4,000 square foot building, the taxes are just over 10 grand a year. 10 grand, that's in the city of Flint for a 4,000 square foot property. And so what you think you might be doing from a cash flow standpoint, it's going to be important that A, you're being proactive to consider that. I'm not saying don't do the deal, but at least know what you're getting into and make a knowledgeable decision. And if you get to a point where you think that there may be an issue, these are the kind of scenarios where you want to proactively engage someone to help you start your fight because you know it's coming and have your ducks and your documents in order. And so we're here to continue this kind of conversation. We're very thankful for your availability today and being able to throw these things out
And
here.
remember, if you get an appraisal, it will be at state level and local level. It can be used twice. It can be used as many times as you want for a tax appeal.
Tax appeal appraisals, we call you approximately how much for a single family home?
400 to 500.
Okay, And do you do up to 4 units?
Yes, I do.
Don't go over? Do you go over 4 units?
No, I cannot.
Okay.
No.
All right, so for your tax
Yeah,
bill
only
appraisals up to
yeah, I
4
can't do
units,
commercial.
you should
Yep. Any questions? All right, thank you. Oh, was there a question back there?
Can you speak to the equalizer that's above all the assessors that plays a role in this scenario here?
Can I
The
speak?
county equalization.
Yeah, the equalizer, like a state equalizer or a county equalizer. They want to get so much money out of that county every year. So they do this, that, and the other thing, they gotta meet their goal. Have you ever ran into that person or dealt with that person?
No, I never have, but that's,
Are you
yeah.
aware of that person?
Yes, I am aware of that person, but no, I've never dealt with that person. That would be a very interesting conversation.
I don't think she's coming to this meeting.
Equalizer for, say, Oakland County or Livingston County or Genesee County?
The treasurer.
They are.
Treasurer.
The treasurer's equalizer?
Well, the treasurer tells you how much money she needs.
See, you asked that question. I went on a local level once in Argentine Township, and I had all the proof I needed, and I gave it to them, and this is what the board told me. They said, well, we only have so much money to work with, and we're out, so, you know, you're just out of luck. That's one that I hired somebody and went to the state, and Argentine Township ended up owing me money for 4 years.
I love getting refunds.
Yeah, that's great. Thank you very much.
All right, so more on the, before our tax accountant speaks, more on property taxes. She's give you a big insight on appealing them. I've run into this a few scenarios, which same scenario Bernard has just been explaining, of trying to figure out what your taxes are going to be when you buy it. So I've always been told that it was 35 or 40% more for homestead versus non-homestead. Well, in Mundy Township, it's 52% more for non-homestead. And I have a sheet that I gave everybody that shows you how to calculate what the taxes potentially are going to be based off of what they currently are. So this is a real deal that I bought on Alfred Street in Flint Township, and I was considering keeping this 1970 built ranch as a rental. It has been a great rental until I discovered how much the taxes were going to be, because they were paying $1835 a year. And this is a similar scenario because it was a single owner home built in 1970. So they were paying $1835 a year. So if you go down to about the middle of this, I show that $1835 old tax. And doing algebra, if you guys remember doing algebra where you put the two next to each other with the equal sign and you do the algebra. You don't need to know how to do that because I showed you the formula here. But it's $1835 is the old tax times $79,900, which is the SEV value, not the taxable value. And it gives you a stupid high number of 148 million. And if you take the 148 million and divide it by the old taxable value, it'll tell you what the new taxes are going to be based on the millage rates and what school district that home's already in. So that if you stayed homestead and bought that house, your taxes now are going to be $3,098. Well, that's when it gets really interesting, because I was like, okay, it's only 35-40% more for non-homestead, so I'm like, that's $4,200. Well, if you actually Google Mundy Township millage rates, homestead versus non-homestead, it pops right up, and this little chart here actually shows you the rates based on school district. And this house was in Carman-Ainsworth School District, and a homestead rate is 34 mils, and a non-homestead rate was 52 mils. So I had to go back and do some more algebra. And I put that math at the very bottom, the 24 mils minus 52 mils minus 24 mils, 30, it's supposed to be 34 mils, I have a 2 on there. But is 18 mils difference. So 18 mils divided by the original 34 is a 52% increase for non-homestead versus homestead. So If I'd have bought that house and I rented it, my taxes would not have been $1,835. They'd have been $4,700. It was $46.99 and some cents, so I made it $4,700. So I decided to sell that house and make my quick 40 instead of hold it, because my taxes were going to be $400 a month, and then I have insurance, and then they're going to raise my taxes 5% a year, the max of the Headley Amendment the last 2 years, and it wasn't worth owning, in my opinion. So what he is saying, make sure you do your homework, because I've found the biggest deal killer and the biggest thing holding me back from buying a lot of deals lately are not how the deal runs today, it's how it's going to run when the taxes uncap. And it almost, taxes uncapping on my first big deal, I'm not exaggerating, like literally almost bankrupt. So they went from $24,000 or something to $58,000, and I got a $36,000 tax bill when I was negative cash flow to begin with. So that was fun.
Car wash was that?
Yeah.
They appraised it, I paid $450 for it, they appraised it for 1.2, right?
I have the same thing. I paid $400 and they appraised me for 1.2.
Yeah.
So some of these deals, the only person that wins is the township. They always make money.
You know, you break it down. One of a recent deal I bought, I think I get $750 a month rent, 2-bedroom. That's $9,000 a year. The taxes are about $900 a year. To me, that's cheap. It's good. That means effectively each year, the municipality is my partner with a 10% stake. They get 10% of my money off the top. That's what happens. You know, I start looking at insurance. I start thinking about if I'm carrying any other costs. They're a partner in this thing. They're not going anywhere. Well, some of the deals I've had, I do the same numbers, and all of a sudden, my taxes are 25 or 28% of my monthly expense. I've got to stop and ask, do I really want the municipality to be my 28% gross partner? They get their money off the top. I'm waiting for the pennies at the end. Oftentimes, that changes the way you approach a deal, and to give credit to what Ed was sharing, that may make the difference where you may be rehabbing a property to rent it. You may say, you know what? Let me throw an extra $3,500 for a slightly nicer fixture here and this, that, there, because I'm just going to flip it and keep moving. And it's better to understand that at the beginning. And so with that, you know.
I had the same scenario, City of Durand. I was buying houses back there in the recession for $5,000, and I appealed the taxes to the state, and I got them reduced where they were taxing me on like $30,000. So my taxes are like less than $1,000. City of Durand has high taxes to begin with, but now those houses are selling for $120,000, $140,000, and people are like, well, why aren't you dumping? I'm like, well, if I sell it and I buy the house next door, I go negative cash flow $3,000 to $4,000 a year, because I'm gonna have to pay retail for the next one, and I cannot replace those low taxes. So I'm just stuck holding and owning everything I own because I appealed all my taxes. All right. Bernard, introduce our speaker.
All right, well, you know, I want to pause as we're transitioning. We've got a treat that I won't be long, because Frank is very knowledgeable, and he can give you a surface level of a lot of topics, or he can go dig deep on a few topics. I'm curious just to get a feel for the room. This might help Frank too. How many people here, you own, let's say at least, how many here you own at least 3 to 5 units? How about 10 or more? All right. I can continue. I know that there's much higher thresholds I can get to. I'm going to stop there. How many people you've owned a property for a year or less? Your first property, you're just getting going, but you got it. Congratulations. Kudos to you. Good stuff. How many here you've owned property for at least 1 to 3 years? 3 to 5 years. I'm not going to ask your age. I see some bashfulness. What's going on? Let's say 10 years or more. 15 years or more. See, I'm asking these questions because it gives a pulse for what's the experience level in the room. You know, if we need to speak towards, hey, I'm brand new in this thing and I have no idea, we cater the conversation a little differently. We've got a lot of seasoned folks in here. Not that we're not going to speak to those that are new, but this helps to understand who we're speaking towards. Who's been in this thing at least 20 years? Now I give you the option to not participate. 30 years? 35, 35, 35, can I get a 35, 35, 35, 40, 40, 40, can I get a... All right, and I'm gonna stop right there. I'm gonna stop right there. With no further ado, I'm gonna say this. I think Frank is gonna do a phenomenal job. I think that as you are building your business, I had a wonderful conversation with one of our members today, and they said something that's like music to my ears. They said that they're focusing right now on working on their business and not in their business. And for those that may not understand, when I first got started, I got this frame of reference from folks who, you know, saw their uncle and their granddad. Hey, I own rentals, that means I keep tools in the truck and I go fix on them when they call me. That's working in your business. Then there's others who are like, I don't fix a thing, but I gotta rely on a management company and a contractor, and maybe they're charging me more than I should, but I don't do that stuff. But I'm focused on building deals, building wealth, building revenue. That's working on your business. And so the conversation today, I hope, helps you to be more skilled in how you're working on your business, not just working on your houses. So with no further ado, let's welcome Frank Alcini, who's going to give us some insight from a tax man's perspective.
Hello, everybody. Thanks for having me. Just anybody with any questions, throw your hands up. Don't be afraid to ask any questions, large or small, and we hope to be able to help. But a little bit about me. I'm a real estate investor, also a CPA by day. Spent a large part of my career with a large national firm working in their construction real estate industries group. And I work with people with small single family to large multifamily, commercial, self-storage, and kind of everything in between. So I can kind of dive deep into things and sometimes ramble on stuff. But one of the things you mentioned earlier about the taxes, though, I see that often, you know, the last few years, the way the market's been, it's kind of easy to get a deal, you know, just go rent it. But, you know, those of you looking at your property taxes and, you know, you also had that quick pivot. I could, you know, turn it into a sale, you know, easily if, you know, I didn't like the taxes. And I have a lot of investor clients that, oh yeah, I sold those. I got my assessments and I didn't budget correctly, but there was a market there that they could easily unload it. And a lot of times that's just killing that deal. So definitely something to look at. Then on the appraisal side that they touched on, that's also big, you know, those of you that have properties and, you know, if you guys die, you know, there's a step up you get at death, and it really should be evidenced by an appraisal. So I'm a good appraiser and having that contact, that's great that she came out today. But so have some updates, you know, you guys just throw out your questions at me. Right now, it's kind of been a slow year from the tax side of things. We just got over the 1099 hump. Those of you, I hope, that file over 10 electronically filed, that went into effect this year. We did postpone the 1099K requirements. You know, there's PayPal, Venmo, those type of things. People that are transacting money that way, we're supposed to receive that for transactions greater than 600. IRS keeps making their own rules and pushing that off. We're fine with that. We don't like them making rules, but in this case, we'll let them. Bigger thing, a lot of you probably heard of bonus depreciation. You know, went down to 80% last year. Then now it's, you know, 60%. A lot of people have said it, oh, bonus, they're taking it away. Bonus was a one-year thing back in 2002 that it started, and it's been in one form or another. Right now, the Senate is on break as of last Friday. It passed the House to retroactively enact last year being 100%, and whether that's going to pass or not, I don't know, on the bonus appreciation side of things. Then also, a lot of you have LLCs in here. Any of you guys LLCs, multiple LLCs? Are you guys familiar with the Corporate Transparency Act and the consent requirements this year? Yes. So Right now, FinCEN is the Financial Crimes Enforcement Network, and historically, from a tax standpoint, my involvement's always been if a client has an account greater than... I don't... Oh, shit.
No. Okay, now it's on. So I was asking about the Corporate Transparency Act and FinCEN. Have you guys heard anything about that? Those of you that have LLCs, this year, starting January 1st, this year through December 31st, anybody that has an LLC is going to be required to, or a corporation, it effectively is any entity that was organized under state law. So you have to file a statement of beneficial ownership. So what the government wants is my name, address, copy of my driver's license or my passport. So for instance, let's say I own LLC A owns B, B owns C, then D, and I effectively am a beneficial owner of all 4 of those LLCs. Some of you guys probably own multiple LLCs, so you're going to have to report yourself as a beneficial owner on all of those LLCs. Those of you that own them, when you do file, for instance, it gives you an identifier. So I update my information, and then I get an identifier. LLC number 2, I just enter my identifier, so I don't have to re-enter all that. When you do that, save that identifier. Do not exit off that screen. I'm not really looking at it with clients till later in the year. They've already changed the rules a few times and things haven't worked. And one of my clients went ahead and said, oh, I can do it. He forgot to get his identifier, so now he's got to upload his information on every one because he can't get his identifier. But the penalty for not doing that is $500 per day, up to $10,000, and up to 2 years in jail. So if you start an LLC or corporation this year, you have 90 days to file that. You don't have the entire year. So anybody that has LLCs that were started prior to January 1st, you have the full year. And if you'd like, go to my website. Later in the year, I'll just be blasting out emails, check at this. If you've already done it, then that's fine, but just more of a reminder. I'm not looking at it with clients till later in the year. Right now, California has said CPAs can't even help their clients with this. This is practicing law. Texas has said that, because they want the attorneys to get paid. Texas has said anybody can help somebody do it. Michigan's been silent on it, but what that means is, let's say my wife and I both own an LLC, and then that LLC is partners with one of you guys. We're beneficial owners in our LLC of 50%, and we may be beneficial owners in your LLC or that joint venture LLC, so we'd have to disclose ourselves even though that LLC has no name. So defining who your beneficial owners are is a little bit of an exercise on more complex structures.
Most LLCs just file on your social security number anyway on your normal tax report. Why is this going to give them any different information?
Actually, most LLCs don't. Only single-member LLCs do. But so, for instance, so those of you that are in partnership LLCs, that LLC files a partnership, and then us partners get a K1. Now, if I held my interest in a single-member LLC 5 years ago, it used to have my single-member LLC name and ID on it. They've already changed the K1s because now they want it to say Frank Alcini, my ID, then underneath it'll say my single-member LLC. That's all just a tax form. This is a federal government thing with the FinCEN, so what it's really trying to do is stop money laundering and the financial crimes and financial crimes enforcement is under that. Anybody that's ever heard of foreign bank account reporting, if you have signature authority on accounts greater than 10,000, that's a FinCEN form also, but the IRS was tasked with
enforcing it, so it was built into that. It's just a function that I provide to clients and file that form. It's actually separate from their tax return, but it gets filed with their tax return. This FinCEN beneficial ownership form is totally separate, and you can go to FinCEN's website. It's got a big questionnaire, and what is a beneficial owner? It may be you and I are 50-50, that's real easy, but we also have a president that runs the company, has zero ownership, but makes $100,000 a year. He has substantial management control. Under their definition, he would qualify as a beneficial owner. And there's a big walkthrough thing on there. I went rush and go file it tonight because I think over anything with government, they rush it out, then they haven't even figured it out. All your stuff, you have till the December 31st of this year to get it filed. And I think they're gonna fix it, interpret it, revise it, do different things, but it should be on your mind. And that covers any single member LLC, anything. And there's some exclusions, public companies, accounting firms that do public audits, inactive companies. Inactive means I set up a company and I've done nothing with it. Inactive does not mean my 3 single member layers deep that then own my rental LLC, because they all own an asset. They're not inactive. I mean, technically for taxes, they're disregarded, but technically they're in the ownership. If I just set up ABC LLC and have never done anything, I can get away with not filing that one. But if you're gonna file them, you might as well just file them all.
And is there enough within that to keep honest people honest and dishonest people, will they have to sell the way out?
Well, if they don't report, you know, I mean.
What are they gonna catch? In other words, a bad guy wasn't gonna report the money to start out with. A good guy's gonna report the money. How's this gonna be different? It's just 3 or 4 more forms.
It's kind of like gun laws, Henry.
I agree with you, but if it ever comes a day that they have to look it up or something and come to find out, like I said, the penalties are $500 a day up to $10,000 and up to 2 years in jail. I mean, I can't see anybody going to jail if you just didn't file it, but if it's a one-time, I forgot to file this form because I didn't do it, are you gonna pay 10 grand? Possibly, it depends what happens, you know, if it was just, I
If you're
said
the
something.
first guy, you're paying 10 grand, because you're a big example.
Oh, yeah. But I mean, if you're doing your taxes, they have no wrongdoing, I doubt you'll ever see prison, but it's just more enforcement. And it's part of the Corporate Transparency Act from 2021.
So I purchased 3 houses, 3 different land contracts, on 3 different contracts from the guy that owns them as a LLC. What is he has not kept them up or nothing, so there's 2 houses in one.
Did you buy the LLC?
No,
You just bought the house?
just bought the house.
Well, then-
Land
Did
contract.
you put them in an LLC?
No.
You're good.
Yes, you're good.
No LLC.
It doesn't matter what he's done, and I don't really care. Are banks gonna though look at, have you complied with this? Because there is people they can release this information to, so it's gonna be a public database to use, but not public that I can just go search it. But if I'm a bank, I can pull that. I have to have a reason for doing it. So now if I'm giving you a loan, are they gonna check if you're in compliance with the Corporate Transparency Act? Is that gonna be something, you know, like you said, how are they gonna catch you? But if you're not in compliance, that's a potential hidden liability, so why would I give you a loan when they can come and attach a $10,000 penalty to something?
I give a loan from Henry.
So just keep that in mind, you know, I mean, that's, you know, out there. Right now, we've all heard the IRS is going to be ramping things up. Not sure how many of you are familiar with the ERC claims, and you know, all of you got phone calls last year. You qualified for $26,000 per employee, and it never stopped. And they called it something different. September, I think I was in here last year, and somebody asked me, "Well, my friend got some money. Why can't I?" And my accountant said, "I don't qualify, but he got some money." And I said, "I'd probably follow your accountant," because I had a few clients who qualified, not many. But September 14th, IRS put a hold on all ERC claims and then Right now, they're actually starting to look at those, so anybody who qualified for the max, I'd go back and double check because they're gonna start looking at those more aggressively, and they're gonna potentially, people are gonna potentially have to pay the full amount back plus 75% fraud penalty. So there's certain indicators. For instance, if I calculated it, you got a $100,000 credit and my fee was $25,000, coincidentally 25% of that, that's probably an indicator it's, you know, it was a fraudulent claim, not just for the time. So something to keep in mind. The calls never stopped from clients, do I qualify? And I said, we looked at it under all different names, whatever marketing tactic they were using at this time, you know, it was called something different. So right now, then next year, the estate tax is gonna be sunsetting, so it's gonna go from 13.6 million per individual down to 5 million per adjusted for inflation. So any of you that have some larger portfolios, biggest thing I always say, anybody who has multiple real estate or LLCs, you really need to look at your estate plan. I don't care if you're talking estate tax or just for your planning. What happens if you die tomorrow? Can your family write checks to pay your bills? You know, I mean, that's the biggest thing. I can tell you horror story after horror story. And I've got clients with broker accounts. You set up beneficiaries, they can figure that out. Rental properties are a little bit different, you know, what happens, or does my wife know how to pay the bills or keep the lights on for my tenants, you know. So just getting those things in place. And those of you, if anybody's gonna be dying soon, don't transfer your property to your family members before you die. Transfer it after, because for instance, if you transfer it now, your basis transfers with them. If they inherit it the day after you die, they inherited it at fair market value. So those $5,000 houses he was buying, if his family, if he transfers them, that's gonna be their new basis. Where if something happens to him and somebody inherits it the next day, they inherited it at fair market value and get to start the depreciation again on that. So, and then that's where you're going to reach out to the appraiser, get the fair market value. We're going to make the appropriate elections, establish the new depreciation, or sell that property tax-free.
Hey, could you repeat?
Oh, as far as inheriting or transferring that, so for instance, you know, I've always heard, you know, somebody, you know, grandpa's going to the hospital, he's dying, you know, transfer all this stuff now, get some quick claims, if they're transferred before he's dead, his basis transfers to me. So why don't I let him die? I inherit that property he bought for $5,000 or $10,000 for $100,000 fair market value, and then I can either sell it tomorrow, and my basis is $100,000, and I sell it for $100,000, or I keep it as a rental and I reestablish depreciation.
You get a stepped up basis.
Yes.
Can I clarify that even further? So for example, because I need to be real, some of us, man, tax person just do the stuff, give me the paperwork back, I'll sign it, and let me do my life, and that's it. So when he's talking about basis, in a lot of cases that basis is what you bought it for. If there's certain, you put a new roof on it, certain things that you've done that have contributed to the structure of the property, that's your basis. The issue is if you got $5,000.
Less your depreciation.
Yeah, let me not be the tax man. You're the tax man. But I'll just say this, you know, you sell it for $100,000, they're gonna hit you for capital gains, which means whatever that profit is, the government's gonna be like, hey buddy, I know you've been paying your property taxes, but I want my cut too. You made some good money here, and depending on how you're structured, they're gonna take more. So part of what he's describing is that if that basis stays the same, you've got a bigger chunk to have to partner with the government on. If you have a process, I assume through a will or a trust or something, where that transfer doesn't happen until after they die, all of a sudden, instead of the government having this $95,000 profit spread that they get a cut off of, if the basis is $100,000 when you get it, they don't have that big chunk that they get a partner on. It's all yours or your heirs, whoever it goes to. And that's part of what he's describing and the mechanisms that are needed.
So Frank, you have to establish value based on the date of death, right?
Date of death or 6 months later, depending on an alternate valuation date, but yes.
So for that, can you use a market analysis or do you need a certified appraisal? Depending on the value.
Kind of depends on the value. I mean, if you're in the estate tax realm, most likely plan on an audit, have a certified appraisal. If it's a smaller estate, you know, you can have a market analysis, you know, I mean, and be okay with that, you know. But when you're sorting things out, also from an estate standpoint, depending on how things are going, do you just want to rely on my realtor to divvy up stuff between me and my family, who's going to give me a broker price opinion just based on some comps, and now I buy out my siblings, or I do whatever, or should I just go get an appraisal and establish that, you know? So, I mean, it's going to help you just as whoever's administering it, you know, the more formal the document also.
So to have that title transfer after someone dies, like how does that happen in a practical sense? How does someone here make sure that they're doing it that way?
So in a practical sense, if it's property owned by Frank Alcini and then I die, now it's going to go to probate and then people are going to fight it out and then it's going to get sorted. Or I could put it in an LLC and then my LLC interest is owned by me, which then that's still going to go get probated, my probate interest, but the title of the property is going to be owned by my LLC. Or another step is you have a revocable living trust in place. So what I have is essentially a document that says the Frank Alcini Revocable Living Trust dated such and such. That trust document names somebody as my trustee. I'm the trustee till I die. Then I have a successor trustee that steps in, and then effectively all my assets that are titled in my trust are still mine to buy, sell, blow, spend, do whatever I want while I'm living. When I die, it becomes irrevocable by default because I can't revoke it. Applies for an EIN number, then let's say you're the trustee on my trust, you effectively just enter my trust document with the court. They don't know whether I own 1 property, 50 properties, and then you step in as the successor trustee. You present that to the bank, you should be able to start writing checks, keep the utilities going, keep the property taxes, all that stuff. You have clear title or clear power to start conducting business, sell, do whatever, and then you just follow the terms of that trust and distribute that. At the same time though, now, let's say it was someone else's trust and I'm still alive and I'm working on that LLC, we're going to go get an appraisal done or evaluation of those properties. Dad's $10,000 properties that he's depreciated down to 0 because he's owned them. Now they're worth, let's say, $100,000. We're going to make the election, step up the value, and then start depreciating them over time. Right now, I've got a client, father-owned multiple rentals. He had about 10 and 10 owned by 2 single-member LLCs. Owned them for many years. Depreciated them almost down to 0. So he had them like almost 27 and a half years. He died a few years ago. His heirs were, his wife got 50%, his trust got 50%. So right now they, we're doing 2 LLC returns. The ownership has not changed, but upon his death, those LLCs went from single member to partnership because the partners are his trust and his wife. And then we made the step up for half the portfolio. Half of each house got stepped up and is getting depreciation. So right now, the trust side of things is effectively not paying much in tax. They sold 3 properties last year, so mom got half that gain. She's going to have some tax. The trust got the other half that of the proceeds and is effectively going to have a very small gain from his date of death till now. all that money went into the trust, which mom gets to live off till the rest of her life. She's in assisted living. She's living on a lot of that cash right now, but there was no taxes being paid. And then if something happens to her at a future date, I'm not going to say tomorrow. Last time I met with a client and said, if mom hypothetically dies tomorrow, and guess what, mom died the next day. That was 2 years ago. But so if something does happen to mom, we'll step up the other half. It'll be in these LLCs. They can either continue on with the LLCs, sell everything, do whatever they want to do, and then effectively the kids are just probably going to end up selling the portfolio over time and then just take their cash and move on. So.
Right, so,
Now, when you said the estate depreciation is going from 13 million back down to 5, does that mean that we're back in a market where small business or the family farm has to be sold to generate the money to pay the taxes? Is that the same market we used to be in?
Yes. And it's going to be 5 adjusted by inflation. When it comes out, it'll be like 6 or 7 or something, you know.
4 for 13?
Yeah. But yeah, that whole idea about this family farm, that dates back to when the estate exemption was only $1 million. Then they kept bumping it up because they knew they had to raise it up. Then in 2010, we had no estate tax because they never fixed the law. That was the year Steinbrenner died. And then ever since then, it went to about 5 million. Then it raised up to, and it's progressively getting up there, but then it sunsets next year or in 2025, which with everything in taxes, it's usually a 5 or 10 year plan because we give some tax cuts today, pay for it later, and the idea is it never sunsets because we keep fixing it, but our government seems to be somewhat dysfunctional these days. So.
I have a question, Frank. Will a Ladybird deed give you stepped up basis or no?
Arguably, no, because it would have been done before, and that I've never seen really done. I've heard it both ways. I think they could push it. I think a Ladybird deed in a certain situation is going to probably be a smaller estate portfolio that's technically not really ever looked at by the IRS. If it's a larger plan in place, it's going to have a trust and different things in place. But I mean, technically a Ladybird, if it's done today and then filed later, it was effectively
But a Ladybird doesn't go in effect
until it gets filed. So
But that's the transfer upon death.
yeah, so and that I mean it's kind of loose, I think.
yeah, that's tough. So to make some things a little bit more tangible, because I think you're grasping a lot of what he's sharing, but two things I took out of what he was saying. So for example, we're using this figure, you bought a house for 10 grand, it's worth 100 grand. You've been milking the cash flow for a few years, but in the back of your mind, you're like, hey, I'll pass this on to the kids, the grandkids, my spouse. Let's say you've got 3 of these. And you're thinking, great, at whatever point in time, I'm just using this loosely, here's 300 grand that's gonna be available for my grandkids, isn't that great? But what you don't realize is that it's going to get hit with taxes, as he's describing, and what you think you're leaving to your grandkids, what you think you're leaving for your spouse, the government is going to take their partnership cut first. The government is gangster. They're going to take it. They're not asking permission. They're going to take it. And part of what he's describing is a trust. I think that Craig Federline